Have you ever caught yourself imagining a life where your investments are the ones working overtime and not you? Think about it. Building a passive income that frees you from the daily grind. Today, we're diving into the JP Morgan Equity Premium Income ETF, ticker symbol JEPQ, with insights that might just change your game plan. This ETF's performance, with an 18.78% total return in the past year, has caught my eye, and it's time you take a closer look too. And just to be clear, JP Morgan has two dividend ETFs, the more well-known JEPI and the newer JEPQ, which will be our focus today. Your time is valuable, so I won't waste it. Here's exactly what we're covering. First, we'll break down JEPQ's fundamentals, like its low expense ratio and how it targets premium income from leading stocks. Next, we'll explore why JEPQ's mix of tech-heavy holdings has me excited, especially in today's market. Then we'll run some real-world scenarios. I'll show you how a $50,000 investment in JEPQ could outperform your day job's income with updated returns and growth. Next, we'll cover why JEPQ could be a powerful long-term play for those looking to blend income and growth. And finally, we'll compare JEPQ to SCHD and JEPI to see which one is better for you. Stick around because the ending will surprise you. And if you're new here, hit subscribe and ring that bell so you're always in the loop. Let's jump right into it. The JP Morgan Equity Premium Income ETF, better known as JEPQ. Here's the deal. It's a strategic play that combines a focus on premium income with a low expense ratio of just 0.35%. Think of JEPQ as a tech-forward powerhouse with almost half its portfolio in technology stocks. This isn't just any ETF. It's built to capture premium income while still keeping you connected to growth sectors like tech, communication, and consumer cyclical stocks. But here's where JEPQ sets itself apart. It's not just targeting high dividends. It's tapping into premium income by selling options. What does this mean? While you're invested in top-tier tech companies like Apple, Microsoft, and Nvidia, you're also earning additional income through option premiums. It's like having your cake and eating it too. JEPQ manages to deliver income without sacrificing the potential for capital appreciation, all while keeping expenses in check. JEPQ isn't just about the short-term gains. It's built for investors who want to play the long game. Its blend of income generation and growth exposure means you're not just relying on dividends. You're also positioned for market upside. And with 49.99% of its holdings in technology, JEPQ taps into some of the most dynamic sectors in the market. It's a balanced approach that doesn't lean too hard in any one direction, giving you a smoother ride in both bull and bear markets. Here's why JEPQ has me excited. It's not just another ETF. It's strategically loaded with tech giants like Apple, Microsoft, and Nvidia, which make up a significant chunk of its holdings. These aren't just companies, they're market leaders with robust growth potential. And with JEPQ's approach to generating income through options, you're not just waiting for dividends, you're actively earning. Plus, the fund's 18.78% total return over the past year shows it's more than just hype. JEPQ is well positioned to benefit from whatever the market throws its way. In a rising interest rate environment, premium income strategies can provide a cushion against volatility. And when rates eventually come down, and they will, the tech-heavy composition of JEPQ could see significant capital gains. This is the kind of flexibility that makes JEPQ a standout choice for income-focused investors who still want to capture market growth. Let's talk about the heavy hitters in JEPQ's lineup. Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, better known as Google, Broadcom, Tesla, Netflix, and NDX9. These top 10 holdings account for 41.83% of the fund, and they're not just big names, they're dominant players in their sectors. This concentration in tech and communication means JEPQ is tuned into the pulse of innovation and growth, making it a compelling choice for forward-looking investors. JEPQ's sector exposure is heavily weighted towards technology at 49.99%, followed by communication services and consumer cyclical sectors. This isn't by accident. It's designed to capture growth where it's happening most. But it doesn't stop there. It also has stakes in healthcare, consumer defensive, and even a sliver in utilities and financials. This diversification means you're not putting all your eggs in one basket, but you're still staying close to the hottest sectors of the market. When it comes to income, JEPQ delivers in spades. By focusing on option premiums, it adds a unique twist to traditional dividend investing. It's like having a second source of income, boosting your overall returns while still keeping you in the game with high-growth tech stocks. The 0.35% expense ratio ensures that more of that income flows back to you rather than getting lost in high fees. This dual approach is what makes JEPQ a standout in a crowded market. For our dividend calculator, we need a solid dividend yield figure, and from JP Morgan's site, it's 9.93% for the last 12 months. Keep that 9.93% locked in because it's going straight into the initial annual dividend yield input of our dividend calculator. I want to make sure you know where these numbers are coming from because the final numbers will blow your mind. And also notice I'm using the annual yield, which is the lowest yield because I want to stay conservative. Next, we need the average yearly growth of the dividend payout. In the last year, that growth was a whopping 29.82%. Now, I prefer to use the averages over 5 or 10 years, but we can't do that because JEPQ started in 2022. So I'm going to stay conservative and use SCHD's 11.01%, and that's going into our expected annual dividend amount increase percentage per year, input in the dividend calculator. Now let's talk about stock appreciation. Since JEPQ's inception in May of 2022, it's produced a return of 38.63%, and that's without even counting dividends. JEPI has been a little more conservative and has a stock appreciation of 13.16%. That being said, with 49% of JEPQ's holdings in technology companies, including NVIDIA, it's possible JEPQ could maintain high appreciation numbers. But for today's video, I want to use a lower share price appreciation percentage that I believe is more realistic. In the last year, JEPQ is up 7.61%. Sure, there will be ups and downs, and I prefer using an average of 5 or 10 years, but we'll use 7.61% for our expected annual share price appreciation percentage. The key figures I'm using for the initial annual dividend yield, expected annual dividend amount increase percentage, and expected annual share price appreciation percentage are all based on historical performance. This isn't some inflated estimate. These are real numbers from JEPQ's track record or toned down numbers due to the limited history. And one of the most powerful strategies with JEPQ is reinvesting the premium income to buy more shares. This compounding effect accelerates your portfolio's growth, turning even modest returns into significant gains over time. It's like a snowball rolling downhill. Each premium payment reinvested adds momentum, helping your investment grow faster and bigger than just sitting on dividends alone. Now let's dive into a scenario that's not just theory, but a potential reality. With just $50,000 in JEPQ, you could set yourself up for income that rivals or even surpasses your full-time job's paycheck and sets you up for a rich retirement. And if you're finding value here, a like and subscribe would be awesome. For those of you looking to dive deeper, check out my Patreon for real-time alerts and exclusive insights. Plus, there's a free trial link below for my custom TradingView indicators. Thanks for sticking around. And now let's run the numbers through the dividend calculator to see exactly how JEPQ could transform your financial future. All right, let's go through our dividend calculator and set everything up. First thing we want to do is come down to distribution frequency, and we want to change that from annually to monthly since JEPQ pays monthly. We want to make sure that the DRIP is on. Our starting principal today is going to be $50,000. There we go, 50, 1, 2, 3. Annual contribution we'll keep at 0. Our initial annual dividend yield, that's going to be 9.93%. Next, we need the expected annual dividend amount increase percentage per year. And this can be a little bit confusing, but this is a very important number. So for that, we can hover over the little question mark, and it tells us if the dividend amount grows at the same rate as the share price, the yield will stay the same over time. If you expect the dividend yield to increase over time, enter a slightly larger expected annual dividend amount increase percentage than the expected annual share price appreciation percentage. So we're actually going to start with 11.01%, but I got to warn you, this is something we're going to have to change because this is just going to blow these numbers away. And then our next one is going to be the expected annual share price appreciation percentage per year. For that, we're going to use 7.61%. And now we are ready to go ahead and hit the calculate dividends button. And boom, we can see some crazy numbers here. Ending balance, $21 million, total return, the annual dividend income, that would be nice. But what's really surprising here is the average annual return is 22.42%. Yes, that's high, but again, is it possible? Maybe, but I want to tone this down. So what we're going to do is we're going to go ahead and change our expected annual dividend amount increase percentage from 11.01%. Let's drop that down to 4%. And now when we hit calculate dividends, we get a more realistic number. And now at the end of year one, we can see that our principal started at $50,000. Our annual dividend was $5,197. Our yield 9.93%. And you can see the numbers coming across here, and that looks, all right. Then as we come down, the thing really starts to grow, and this is the power of compounding and building that snowball. After 5 years, the principal is just over $90,000, annual dividend $8,159. At 10 years, $180,000 with just over $13,000 for the dividend. 15 years, $340,000 and $21,000 for the annual dividend. Coming on down, let's check out 20 years, $617,000 with a $32,000 dividend. 25 years, wow, we just popped over $1 million for the principal, and our annual dividend is now at $48,273. And then at 30 years, $1.8 million and an annual dividend of $68,850. So to summarize our dividend portfolio after 30 years, the ending balance, $2,031,896. Total return, 3,963%. Average annual return, 13.14%. And really take notice of this number. We're only outperforming the S&P 500 by just a little bit, but look how much this has grown to, and this is what we're after. Our annual dividend income, $73,686, and our yield on cost, 137.7%. Does this blow you guys away? Now, I know not everybody is in a position to drop $50,000 into JEPQ right now, so let's run a couple different scenarios. Let's go ahead and say you can start with $10,000 in principal and you can put in $100 per month, so that would be an annual contribution of $1,200. Let's hit calculate dividends and see where we're at. Well, we're at $728,000 for the ending balance, annual dividend income $26,421.28. Let's bump this up to $2,400, which I think most of you guys can do. That's $200 a month. And now we're looking at an ending balance of $1 million, so you're a millionaire. And average annual return 8.87%, annual dividend income $38,105. And now let's do one more, $300 per month, which would work out to $3,600 per year. And again, a lot of you guys can do that. So we're looking at an ending balance of $1,372,000, annual dividend income $49,789. And again, you guys can play with this calculator and run your own numbers. And now let's run one more scenario. I'm really big on investing in retirement accounts and Roth IRAs. And the reason I like a Roth is because it is tax-free. Now, I've had the question before, how can you put $50,000 in a Roth? There are a couple of ways. One, you can do it over time, do your annual contributions. And for high income earners, something you really should do is talk to your CPA about doing what's called a backdoor Roth IRA. With that, you can put in money quicker. So now let's go ahead and just say you can do it in a Roth IRA. What we're going to do is we're going to take away that dividend tax rate and we're going to set it to 0. Now, if we look at our ending balance before with a 15% tax rate, then it was coming in at just over $2 million, and our annual dividend income was $73,686. Not too shabby, but now if we can do this in a Roth IRA, no tax consequences, check this out. The numbers now change to $2.6 million, and our annual dividend income, $95,297. And yes, you guessed it, I try to do as much investing as I can in my Roth and Roth 401k. Even though we can't predict the market, using JEPQ's historical data gives us a solid foundation for projections. And while we can only base these on past performance, the numbers make a compelling case for why JEPQ deserves a spot in your long-term investment strategy. JEPQ's strong returns, tech-heavy portfolio, and income-generating strategies offer a balanced approach for the savvy investor. By reinvesting your premiums and letting compounding do its work, a $50,000 investment could set you on a path to financial independence. As you can see from today's video, the numbers are insane, and that's exactly why I've laid out every detail so you can see how to run the numbers yourself. Here's the wild part. All of this is based on real historical data from JEPQ. No fluff, no hype. That's just the raw power of math. Don't take my word for it. Try it out on MarketBeat.com's free dividend calculator yourself. Today's video isn't just about investing. It's about making decisions that set you up for life. JEPQ is the real deal, reliable dividends, solid growth, and a track record that speaks for itself. If you're hunting for a financial game changer, this is it. Don't just sit on the sidelines. Get your snowball rolling today, because the sooner you start, the bigger that snowball gets. And trust me, your future self will thank you. So which one takes the crown? JEPQ, SCHD, or JEPI? Look, SCHD has a rock-solid 13-year track record. It's been around the block, it's got history, and it's proven. Then there's JEPQ. This is the new kid on the block. It doesn't have the years under its belt for a full-blown comparison, but it's showing great promise. Now, if we zoom in on the last year, where all these ETFs were playing on the same field, here's how they stack up. Number 1, JEPQ with 18.78%. Number 2, SCHD at 16.88%. And number 3, JEPI at 12.64%. So JEPQ is leading the pack right now, but here's the kicker. We need more data. A few more years of performance to see if JEPQ can keep up this pace or if SCHD will reclaim the top spot. Because consistency beats hype every time. And in case you're wondering, I own both JEPQ and SCHD in my portfolio. If you're serious about leveling up your investing game and want the inside scoop, join my Patreon. You'll get real-time trade alerts, my top picks, and a daily rundown of the hottest stocks. The link's in the description. Don't sleep on the next big opportunity. And hey, drop a comment below so we can keep this conversation rolling. Stay sharp, and I'll see you in the next video.